This is the London Fintech Podcast, brought to you by your host, Mike Ballerman, bridging the worlds of suits and t-shirts, of finance and technology, bringing you insights, stories, and inspiration from the golden age of opportunity and innovation happening in London right now.
Hi, this is Mike Ballerman, and this is London Fintech Podcast, episode 15, and I'm delighted to be joined on the show today by Peter Renton of Lend Academy to discuss where the US P2P scene came from, where it is now, and where it is going. Alternative finance / online lending and borrowing, to be rather more prosaic, perhaps rather clearer, may have been invented in the UK, but as we can see this month, the first multi-billion-dollar IPOs are, unsurprisingly perhaps, in the US. There isn't just this becoming a public company angle, which is definitely a sword with two edges, as we'll come on to later, that it is of interest to UK Fintech, but the whole evolution of the scene and attendant ecosystem, which has been arguably faster than in the UK. In LFP015 with Christian Fays of LendInvest, we discussed the mixed / partial relevance of the term marketplace lender to the UK scene, but for sure it's definitely applicable in the US. We are extremely fortunate to be joined on the show by a man who, perhaps more than anyone in the whole US, has been writing about, commenting on, and holding conferences about P2P more than anyone else. To me, there are two key players in the P2P conference scene. AltFi, home of Rupert Taylor from LFP10, are UK-based, but also have conferences in the US. Lendit, of which Peter is the co-founder, are based in the US, but also have conferences in the UK, which can be seen live online, as well as later on their YouTube channel. In a prior incarnation, Peter was a successful entrepreneur twice over, forming and exiting companies, so knows this whole startup / scale-up game from the inside. Peter has been blogging about P2P for 4 years, long before it was in the slightest bit fashionable in the US, and long before notions of IPOs were anything but a pipe dream. He has also been hosting a Lend Academy podcast for about a year. Oh shoot, there goes my audience. Maybe I should say that US P2P isn't that interesting after all, and avoid losing every listener I ever had. Above and beyond all of the above, Peter is not just an observer of the scene, but a participant, as an active investor and an investment consultant, so has a real inside track in terms of how much the market has evolved over time. There's plenty to talk about, so let's get on with the show. Hi Peter, thanks for joining me on the show today, and let's hope there are no gas leaks this time.
Right, indeed. Thanks for having me on, Mike.
Maybe we need to explain that we were trying to record this yesterday, and there was a gas leak near where you're living, and Twitter was actually quite useful, because I found out that it went on for hours and hours.
Yes.
As the more sharp-eared detectives in my audience, and probably everyone else fairly soon will notice, it doesn't sound like you were born where you now live, which is this place that makes being a member of the Mile High Club both easy and risk-free.
Yes.
I don't want to ask you how many times you remember the Mile High Club, because that'd be rather rude.
Right, indeed. So yeah, I live in the city of Denver, which is exactly 1 mile above sea level.
I'm well known on Twitter for gas leaks yesterday.
Yes, in Colorado. But I am originally from Sydney, Australia, and that's where I spent the first 25 years of my life, and then came over here, and I've been in Denver now for quite some time.
Okay, so have you turned American, or are you still Australian? Or?
I am a dual citizen, so I am still an Australian citizen. I was not willing to give that up. I'm a citizen of both countries, as are my kids.
Oh, right. And are you going to keep heading east and at some time come to the UK and be a trial citizen or whatever they call them?
I do enjoy coming to the UK. I don't know about if I'm going to be moving from there. I don't know if my American wife would be all that in favour.
Well, I must say, if anybody offers me the chance to move to Colorado, I'm there straight away, because in a December in London, where I've been running around today, it's cold, wet, grey. I wouldn't recommend anybody move here.
It can get cold here in Denver as well, but we have...
But you have proper winters, though.
Yeah, we have the benefit of, we have snow, it's somewhat dry, so it doesn't feel as cold, and we also have some of the best skiing on the planet within about an hour and a half drive.
Let's stop that before I get too jealous, actually. I'll start being antagonistic on the podcast if I'm sort of jealous about the skiing out of your front porch.
Well, not exactly, but yeah, close. It's not
well,
far
you should
away.
have just said yes. You've got to romanticise the listeners over here. They're listening in a very sort of dark December, most of them. As I mentioned in the introduction, you did a bunch of real entrepreneurial stuff in the non-financial scene before you moved on to this peer-to-peer lending thing. So how did you trip over peer-to-peer in the first place?
So I found an article on peer-to-peer lending back in 2008. I just loved the idea of it. I thought it was interesting. Like anything else, just filed it away and thought I'll get to that one day. And then one day came not that long later when interest rates, went to zero. The financial world was falling apart, and I didn't really want to be in the stock market and was worried about other investments as well. And I thought this is something that looked like it had a lot of potential. So I started out small and just as a personal investor put in a bit of money, and it went well and I liked it. So I put in more and then just became enamored with it and decided that I'd been investing for about a year before I decided that this is something that I wanted to make as a career. And there was no one really writing about it. I thought it had great potential. And when I came on board, there was literally nobody covering the space. Well, actually, I tell a lie. There's no one covering the US market. There was Klaus Lehmann, wise clerk in Germany, who was covering the European peer-to-peer lending space, and he still does do an excellent job. But in the US, no one was really covering the market here.
Right. It's interesting because, as I'm sure you know, in the UK, certainly 2014 has been a very frothy year for fintech. It's really hit the mainstream media. And we've got all sorts of people trying to hold all sorts of events and all sorts of people turning up, and tourists and gawkers and consultants and snake oil salesmen and the whole works and all that. And unsurprisingly, of the people that I've met in the last few months, it's the ones who've got the deepest roots going back a number of years, who are the most solid trees, as it were. So your background really shows through. Having said that, there's always two sides to it, which is that nobody ever says very much about the fact that actually it must have been a bit difficult, lonely and strange in the early days. It's a bit of a no-brainer doing it now, like there's IPOs and that kind of stuff, but you must have had some times when you wondered whether your sort of 1.5 readers were going to turn up next week when it wasn't very fashionable.
Yeah, no, I certainly did. I was in the fortunate position. I just sold my second business. We had a nice exit from that, and I decided that I was going to take a couple of years off, and I didn't really work that hard, and I was looking for the next thing to do while this was going on, and I had the luxury of being able to devote myself full-time to something without actually being able to produce an income. So I told my wife I'll give it 3 years, and if it really looks like it's not going to go anywhere, I will go and do something else. By the end of 3 years, 2013, I knew that this industry had tremendous potential, and I could really make this my full-time career for a long time.
Yes, in terms of the froth, the world is full of blogs telling you how to be an instant success. But as we all know, the Beatles were an instant success by virtue of doing years and years and years in clubs all over the place and non-stop playing their songs and refining it. And it's a bit like being a gold miner. If you want to find the gold, you've got to dig and you've got to prospect and all that kind of stuff.
Yep.
So it does certainly pay, but it is hard work.
Yeah, and that's one of the things that I think it could have been very easy for me just to give it up because, as you say, you're writing and no one's commenting on what you're doing. You're not getting a whole lot of readers, and but I was really focused and determined to give this the best shot I could. Just kept on writing. Every single week I'd produce several articles. And the thing is, I had enthusiasm personally for what I was doing, what I was covering. So it wasn't as hard a slog. If I was trying to write about something that I wasn't passionate about, I would have given up because there wasn't enough happening financially for me to think I could really make this a living out of this in the early days. But I'm happy that I stuck it out. As I said, I loved what I was doing, so it wasn't that painful.
So it's maybe a good time to come on to you telling us about the US P2P scene as an overview. There are a number of similarities and a number of quite significant differences with the UK scene. So rewinding the clock, what are the origins in the US? Who were the main players? What was happening in the early days?
Right. So the US P2P lending industry really got started with the launch of Prosper in 2006. And this was back, if you remember, there was sort of some irrational exuberance back then where the economy was going well and everyone was paying their bills on time. And so there was a great fanfare actually when Prosper launched. They had a lot of press coverage and this was going to be the next big thing. But they had a business model where it was focused on really pretty much anyone. You could obtain a loan and they thought the wisdom of the crowd would kind of dictate and the peer pressure would dictate people would pay their loans. Of course, then we got the financial crisis and the peer pressure went out the window. People just got laid off and it became a challenge for these borrowers on Prosper. Now, at the same time, Lending Club had launched just over a year after Prosper and they had a different model. They said, we're going to go after prime borrowers. We're not going to let just anybody get a loan and we're going to do things in a way that isn't quite as open and friendly as the way Prosper had done it. Now, keep in mind, Prosper had this sort of utopian view of the world in some ways and people, they could post a photo of themselves and a profile. And
it was very social networky stuff, wasn't it?
Yeah, it was very on social lending. They could you could interact with the borrowers and you could get to know these people. And Lending Club decided that they would encourage some interaction. They were going to do it much more anonymously than what Prosper did. And they also the decision for them to go after prime borrowers only served them very well well during the financial crisis because Prosper ended up with negative returns for investors. They ended up with a class action lawsuit against them.
Yeah.
And Lending Club actually produced positive returns for investors during the, a very small, very, very small positive return, but they did not go into a negative returns during the financial crisis. And that has helped them out tremendously as they've gotten larger.
Oh, that's interesting. Well, people who've been closely reading the financial press recently about the Lending Club IPO may know its origins, but going back to the social angle at the start, they launched on Facebook, didn't they? Some kind of Facebook app.
They did. That was done primarily for PR reasons, I think, because back then, Facebook was still for pretty much a college-focused site back then, and where it was open to the general public, but it hadn't been open to the general public for that long. So they launched on Facebook. They were only on Facebook for 3 months. It wasn't a great borrower demographic. These people didn't have jobs a lot of the time. They were full-time college students, and it wasn't a great investor demographic because these people didn't have much money. But it did sort of serve the purpose for letting them sort of beta test their systems, and they got some nice publicity. But within 3 months, they'd launched a standalone website and were open to everyone, not just Facebook users.
Yes, and it's interesting. I was reading this morning your short ebook, which is very readable. I'll put a note in the show notes about it if anyone wants to check it out. I was surprised you were saying about Lending Club getting positive returns even in the difficult times, because the notes I'd made from that was that in the loans that Prosper and Lending Club had made pre-08-09 crisis, the Prosper had something like a 40% loss rate and Lending Club had a 24% loss rate. Now, obviously, we're not comparing like with like here, but that's still astronomical compared to the kind of loan losses that we had in the UK of Zopas and things like that.
Yeah, that's misleading to some extent.
What, your entire book or that particular statistic, the way I've quoted it?
No, what I meant was that 40% of the loans in some vintages in Prosper actually did default, but they didn't default right off the bat. So you had your total losses were not 40%. In fact, and if you were invested in a broad cross-section of loans on Prosper, even despite the fact they had a lot of subprime borrowers, your return was in the negative single digits. So it wasn't negative 40% or anything. Now, Lending Club had a bit over 20% losses, but again, that's the number of loans that defaulted. That's not the returns that investors received. And the numbers that I've seen, it's between 0 and 2% was the returns for investors in Lending Club's loans in a cross-section of them for the pre-financial crisis vintages. It was a very small loan book back then. I mean, they do more loans now in, probably in a day or two than they did in all of 2008. So it's small numbers compared to today, but they have the advantage that they did have a credit model in place pre-financial crisis, and that, I think, gives people some comfort that they will be able to handle another financial crisis in a good way.
Yes, I mean, there's a couple of points for fintechs there. Everybody's in such a rush to be successful these days, but one of them is that there's great merits in starting small and starting slowly, because your kind of baby steps and your sort of tripping over can be done without too many repercussions, and then you can scale once you've got stronger, I think, isn't it?
Yeah, that's a really good point that I think is probably not emphasised enough, because one of the things that Lending Club and Prosper had going for them is that they did start slowly and they could really evaluate their models without risking too much investor capital. And, one of the things you talk about, one of the assets these companies have now is their track record. That's sort of the primary competitive advantage that Lending Club particularly has, is a long track record, a successful track record pretty much from day one. They've scaled dramatically in recent years, so it seems. Their percentage rate of growth has remained pretty constant for many, many years now. And they haven't sort of suddenly gone from zero to $250 million in a 12-month period. That hasn't happened with them. You'll see the numbers. They've grown steadily, and it's been a very methodical growth rate at Lending Club.
Yes, it's an interesting thing. I've been thinking about the risk in the peer-to-peer sector. It's not announced yet, but I'm going to be writing a column for a certain publication next year on a monthly basis. So I've been giving some thought to the risk in this. And everybody has got risk models, of course, and everybody says that theirs is good. But there's quite a difference between somebody who started a year ago and whose risk model has been good for 1 year, and somebody who started 10 years ago and it's been there through thick and thin and they've stress tested it. Vast difference, isn't it? Which makes it much harder, actually, to be one of these Me Too's, of whom I see too many, frankly, who just turn up both in US and UK and say, hey, we're going to do this as well.
Yeah, and there's going to be some of the Me Too's that are going to be successful, but you take a company like Zopa. Zopa were the very first to launch worldwide, and they have a long track record now, including during the financial crisis. And at the recent Lend It Europe conference, Giles Andrews, the CEO of Zopa, did a fascinating presentation presentation, he talked about how default rates during the financial crisis increased by a factor of 10 from where they were. But despite the fact they increased by a factor of 10, because Zopa's underwriting model was so conservative, they were really focused on the very best of the best borrowers, investors still received a positive return, despite the fact that, again, defaults went up by a factor of 10. I thought that was a staggering statistic and something that really they should be shouted from the rooftops by Zopa, because I think that just shows you how they've been able to run their business. Now, someone who's coming up with a new underwriting model, they might have a year track record. I would wonder if anyone could increase defaults by a factor of 10 today and still produce a positive return to investors. I think that would be highly unlikely. So, my point is that I think the underwriting model is absolutely critical. And if I meet platforms, and I meet platforms on a weekly basis that are brand new, and if they don't have a really strong credit person on staff who's got a long history of underwriting risk, either could be at a traditional bank or some other kind of lender, if they don't have that person on staff, they will not make it. That is one of the most critical pieces of the puzzle, because if you can't maintain good returns during a downturn, you're not going to make it.
Yes. I've got 30 years financial services risk experience in the city, notwithstanding which I saw that presentation, and it was very much to your credit that you allow people to watch it online. So to those people who can't go to Peter's next conference, do watch it live online, because of some brilliant presentations. And frankly, I would never ever have guessed that set of numbers. I could have sat on a desert island for a long time and thought, unsecured consumer lending, in the worst recession apart from the 30s, God, that would be a disaster. But somehow it wasn't for them. So that was really impressive. I think one of the other things that's coming back to the US versus the UK, again, anybody close to the sector, this will be completely obvious to them, but many people aren't close to some of these subsectors of fintech, is that by and large in the UK to date anyway, the recent tax changes may change things, maybe we'll come on to that later, but to date in the UK, the alternative finance online lending and borrowing products have really been pseudo savings products. So targeting small, fairly solid returns. Maybe that's a good time to talk about the US, Peter, especially you having been an investor, where it's not that case. And in the past, you've had returns over 20%, or even with on deck, although you can't invest in that as a peer, I understand, 56% APRs, and it's just huge percentages, and much lower grade borrowers, and so higher returns. So it is much more of a marketplace in the US, isn't it, in terms of a spread of categories of borrowers?
Yeah, in the UK, the average investor is very much risk averse and is pretty happy with a 4 or 5% return. The average investor in the US is not happy with a 4 or 5% return. When it comes to this industry, people would be very happy with a 4 or 5% return in the US if it was backed by US treasuries or something, but that's not happening anytime soon. So in general, the investors in the US want a higher return, and so the platforms have been able to produce borrowers that provide those kinds of returns. And my own personal returns, which I've shared publicly on lendacademy.com, they've ranged between 8 and 12%, and right now I'm getting just around 11. And I'm absolutely delighted with those kinds of returns, and hope that I can continue to earn those for the foreseeable future.
Yeah. Which is, I don't know the maths these days, but you're getting on for 10 times whatever the interest rate is, or Fed funds rate, or whatever those kind of things are called these days.
Yeah, and I'm doing it, realizing this is not risk-free, which if you're investing in US treasuries, it is. But I'm also investing in the higher risk borrowers that these platforms provide, and not everyone has my risk tolerance. I'm betting on the fact that there's not going to be another financial crisis here in the US, because if there is, my returns will probably go dramatically down. I think they'd still be positive. But if you're investing in the super prime borrowers, shall we say, those that are only paying 5, 6, 7%, you might get a 3.5% or 4% return today, and in a terrible financial crisis, you will probably your returns might go down by 1%, and they'll be very, very consistent. So I'm betting on the fact that we will have we might have a downturn, which is fine, but we're not going to have another major crisis.
Yes. Well, hopefully not for all of us. The moral of the story there, though, is that in terms of how P2P has evolved in the US versus the UK, and there's a whole bunch of reasons around this. In the US, you do have a choice, Peter, whereas if you're in the UK, I suspect, and you know far more about the UK than I do, but I suspect you'd find it quite hard to go out there and source loads of 12% loans, because the platforms aren't really providing them by and large.
Yeah, if you look at the main, like Zopa rate setter, they're certainly not providing those kinds of returns to investors, and a lot of the other consumer lenders. But and Funding Circle, you can get a higher yield, returns. But again, probably double-digit returns is challenging. But there are other platforms out there, such as like Market Invoice, which does like invoice purchasing. They offer higher returns, and you've got Assets Capital, even Lend Invest. Some of these are backed by real estate, can offer these higher kinds of returns. So the good thing about that, for the UK investor, you have plenty of options today, whereas the lowest risk is still probably Zopa and RateSetter, but you've got lots of different options now for as an investor to earn a variety of different returns.
Yes, and just before we get on to the US, I mentioned it in passing, but again, if people aren't close to it, they probably won't know the details, that historically speaking, as I understand, in the US, it's always been possible to offset your capital losses by investing in this way against your current income, whereas in the UK it wasn't. So in the UK, simple arithmetic, let's say you invested in loans yielding 15% per annum and you lost 10% of your capital per annum, you wouldn't be taxed on 5% net income, you'd be taxed on the 15%. And you'd have to sort of do the capital losses. So that was a real problem. The government's announced in the autumn statement that that's changing, so maybe that changes the marketplace going forward. But historically, you never had that tax wrinkle in the US.
Well, it's not exactly true. We have a limit, you see. You can only deduct $3,000 of losses, which means if you've got a typical P2P lending portfolio, if you have $10,000 or $20,000, you won't have more than $3,000 of losses, so that's totally fine. But for larger investors, if you have a $100,000 account, then you can only deduct $3,000 of losses, and your losses could well be much greater than that. Now, keep in mind, if you have capital gains elsewhere outside of P2P lending, then you can offset your P2P lending losses against other capital gains. But if you don't, and if you don't have other capital gains, then you can't deduct those losses. You can carry them forward for future years, but there is a $3,000 limit here in the US.
Right, I see. And then again, before we get on to all the excitement around the IPOs, the US scene is much more dominated by institutional investment, even though it's called peer rather than peers, as it were.
Yeah, that's something that's really changed a lot in the last 12 to 18 months. When I first started investing, pretty much every investor on the platforms was an individual investor like myself. And now, as far as you look at the total dollars, Prosper is well over 90% now institutional money. Lending Club, we don't actually know the exact breakdown anymore, but we can gather that there's around probably 2/3 of their platform is institutional money, maybe even a little bit more today. But yeah, so we have gone from being a minority of the platform into being a vast majority. And I think the same is going to happen in the UK over the next 2 to 3 years. You're going to see, if you look at total capital deployed, it just makes sense for these platforms. If you can get one investor that can put down £100 million, that's going to be a lot more efficient to have than try and find like 1 million investors putting in £100.
Yes, maybe it's a good time to move on to IPOs. And I know you were actually on the floor of the New York Stock Exchange, because I saw the photo for Lending Club last week, which is really an epochal shift. Whether it's the beginning of the end or the end of the beginning, we can discuss that. But fintech is a kind of tapestry weaved with threads of many colours, and certainly one of the threads has been a kind of society reaction against the banks because of 2008 and 2009 and all that kind of stuff. And the use of the word alternate or alternative, a bit like alternative comedy, did for some time kind of mean something that, we're not doing the sort of big old bank stuff and all that kind of thing, perhaps more in the UK than in the US. But now everything becomes kind of more institutionalized and that kind of thing. Now, I'm not making a judgment whether this is good or bad, but the flavour changes to something that's just more corporate. And I can think of one obvious fintech in the UK, which used to be kind of gunslinging Wild West, and now it's, heavily involved in PR and fake campaigns to Westminster and, just all the sort of anodyne comments coming out from the business in the same way that you'd expect from any other sort of large organisation. So maybe it's just part of the maturity that you start off with these exciting, sexy, young fintechs, and they just become, it's a bit like at school, you get the naughty boys end up being the prefects. They're very loyal to the system from there on forward.
Yeah, I think that's a fair statement, because there was lots of scrappy startups in the late 90s. Google was one of them, and now Google's incredibly corporate. They're a little different to your typical corporation, but they operate like a very large company. And I think it's hard for any company, once you get to a large scale, to still operate like a scrappy startup. You need infrastructure in place, particularly a public company. You have all kinds of regulations you've got to adhere to, and you've got public shareholders that you need to please. And I think it becomes much more challenging for any large company to operate and keep that entrepreneurial spirit alive.
Absolutely. And just finishing off on the personal investment, if anybody listening to this, and I do have a large number of listeners in the States who can put up with my British sense of humour, presumably, or Australian one maybe, then I really would recommend that they listen to a number of your podcasts. One of my favourites was with a chap called Reflective Rupee, who was the largest investor on some of these platforms and was at a certain time anyway 50% of the secondary market. And they'll learn a lot about investment. And one of the other points, coming back to this institutionalisation, which almost can't be stopped, it's almost part of maturity. It's like you're a young rebel and before you know it, you've got a sort of a family, 2.4 kids, and you're holding down some 9-to-5 job. You did a great interview, Peter, some time ago with the CEO of Lending Club, and he was talking about the fact that once you get to 600 people, you, the single founder in the beginning, can no longer interview everybody. You need processes and, yada, and there ain't no way around that.
Yep. No, there isn't a way around it. And I think it's, you want these platforms to mature and to get more processes in place and to really be able to manage at scale. These platforms can't make money without scale. And, so if you want your money to be safe, you want a successful platform, a profitable platform. And so you want these companies to achieve a large scale and be able to keep growing.
Yes, and it's certainly been one of my feelings through the last 6 months of intensively drinking coffee and beers on the London scene that two things need to happen. The old FS, shall we call it that, need to become a bit sexier, and the new FS, should we call it that, need to become a bit more solid, because we're dealing with people's money here. This is not some sort of chat app where if it goes down for half an hour it doesn't matter.
Right.
When those things go down, people can't move house and all that kind of thing. So Peter, tell us about the IPOs. It's an amazing December after all these years and years. So we've had Lending Club and we've got On Deck coming up.
Yeah, in fact, I had the privilege of being invited by Lending Club to participate in the IPO. Participate as far as being there at the New York Stock Exchange, and they invited a few people along, and it's certainly one of the highlights of my time since I started in this industry, and one of the highlights of my whole career. I watch CNBC pretty regularly, and I've watched other companies go public, and to be part of it was truly something special, particularly given the fact that this is an industry I truly believed in, and other people were coming around to my point of view. And obviously the average investor, was a very successful IPO. It had a large bump on opening day, and it's still going strong. People around the US believing in this company like I believed in it, 4.5 years ago.
Yes. No, it must be real vindication. All those weeks your wife came around with the rolling pin or the frying pan. Like, what are you wasting your time for on that? And you said, it's going to work out. It's going to have an IPO. And for years, people would have laughed at you for saying that. But now it's vice versa, and it's becoming part of the mainstream. And, the IPO's tremendous point in time. I mean, the other one for me, as somebody sitting in the UK observing the States, was when John Mack, who's very much old FS from Morgan Stanley, joined, and Treasury Secretaries joined the board and all that kind of thing. And before you know it, you're a prefect at school and you're part of the establishment.
Exactly.
So in a way, that is the beginning of the end of kind of like, rebel kind of stuff. And it just becomes the new FS and needs to be done in a solid way, as you say. One of my concerns for the business model there, come back to podcasts. One of the podcasts that I've got on auto download on my Pocket Casts, which is the app I use on Android, is something called the Marketing Companion, which is Mark Schaefer and Tom Webster from the States talking about marketing all the time, especially social media kind of thing. They do a very interesting one, and Mark Schaefer this year came up with the phrase content shock, which I thought was a very good one, about the fact that everyone's producing more and more content, but we only have so many hours in the day. And they did an episode called Will Facebook Turn Evil? And basically their conclusion was, yes, it will turn evil. And I need to define their terms. Firstly, it's the kind of, blog title, blog bait that gets people sort of clicking through and all that kind of stuff. So there's a lot of that around in the States, of course, grabbing people's attention. But kind of what they really meant was that, once Facebook had gone public, maybe I've lost track of the time, maybe it was last year rather than this, but I remember it very well, was once it's gone public, the markets around the world, especially in the States, but also in the UK, have changed enormously from when I first started in investment in 1985. In 1985, little me was told there were two types of stocks in the market. There are growth stocks, and they're out to grow. And they're value stocks, and they ain't going to go anywhere, but they pay you a nice dividend. And then somehow, over the last 30 years, kind of capitalism has changed dramatically. And now everything's supposed to be a growth stock. So where they were coming from Facebook was that the quotes, relentless pressure for quarter-on-quarter earnings increases forevermore will mean that Facebook's going to have to keep milking its folks more and more and more every quarter, etc., until it literally, quotes, turns evil, or metaphorically. Now, I wonder whether, one's starting to see the same with some of these businesses. So Lending Club, as you say, has got organic growth for the foreseeable future. It can continue with rapid organic growth for quite a long time. But then it starts to do things like, and I've maybe got the timescale wrong here, I think it was a Forbes article today talking about the fact that introducing annual fees for collecting on all the interests for you, that there's going to be a fee for provision of a sort of passive portfolio. And, does the stock market stuff mean that these guys are going to be under pressure to basically take more out of the platform rather than less, because a tech direction was that you're going to build a platform and the transaction costs get cheaper and cheaper over time, but the stock market just wants more and more money, doesn't it?
Yeah, there is that. There's certainly that pressure. One of the things that I think is going to really serve Lending Club well, and maybe some of the listeners wouldn't know this, but Lending Club has been a quasi-public company in the US now for many, many years. They have had to have publicly available financials. Every single loan that they issue is registered with the SEC as a security. So they have had this scrutiny. They haven't had public shareholders, but they've had to be transparent in their operations as far as their financials go. Now, as a public company, their regulatory burden is not going to be that much different to what it was. Unlike a typical private company that goes public, they have to suddenly produce all this stuff. Lending Club has been doing that now for many years. So that's going to serve them well. The other thing that's going to serve them well is that the CEO of Lending Club and the management team have produced consistent growth for many, many years. Ever since I've been following this industry, Lending Club has not had a down period, a down month or a down quarter. And it's been sort of, here's the number we want to hit, and they hit their number. And now, there used to be monthly, they would always hit their monthly growth. Now it's quarterly. They don't really care about monthly because they've gone to a quarterly cycle. And, I'd be very shocked if they don't hit their quarterly numbers. But having said that, they do have pressures now they didn't have before. And one of the things that has happened is there has been a reduction in transparency. They still produce their data like most of the companies in the UK do. You make the data file available. Well, I shouldn't say most, some in the UK. It's publicly available for download so people can see your loan book. Lending Club's been doing that for many years. But, now in the most recent quarter, we didn't see all of the loans. Just, the vast majority of the loans, the loans that the average consumer can invest in, they displayed them. But they cut out some of the special programs that they have in place, like their small business lending program. You can no longer see any detail on that program in their data downloads. So that's a change. We may see more of those things. As far as fees go, what Lending Club has, they have some leverage anyway, because there's so much investor interest in their loans. They probably have a little bit of leverage there. It's been interesting that they haven't increased fees from day one to investors. They certainly could, but I think we're going to see them tread very, very carefully as far as fees go, because they realize that as time goes on, there's going to be more choices for investors, and particularly if other companies could get to the scale that Lending Club gets to, there is going to be more choice. So I think they'll be careful when it comes to increasing fees and really trying to milk more money out of their customer base. I think they're going to tread carefully.
It's interesting. I'd probably entirely agree with what you're saying, and I think the big difference with Facebook was that Facebook is pretty much not far off market saturation. I don't know what percentage of Americans have Facebook accounts, but they can't get 10 times the number of Americans on Facebook.
Yep.
Whereas, of course, Lending Club is nowhere near saturation and could have 10 times the market share it's got at the moment, no problem.
Yeah, just to look at one company like Chase, their credit card book is well over $100 billion. And, Lending Club to date have still, even if you look at every loan they've ever issued, that's less than $8 billion. And they've got a lot of room to grow. And that's just one company. So you look at the whole consumer, unsecured consumer is $850 billion. That's just one of their markets they're going to be going after. Their small businesses, several $100 billion. And you've got real estate, which is several trillion that they could easily get involved with. I think their runway, which is one of the reasons why their stock is priced so, they're at a $9 or $10 billion valuation today, is because they have massive runway. Investors realize it, and they know that they're investing, that stock price and that valuation is based on what Lending Club is going to do over the next 5 or 10 years.
Right. Okay. Well, that sounds comprehensive, and I think I buy into it. So coming back to my simplification at the beginning about whether the IPO is the end of the beginning or the beginning of the end, I think I buy your thesis, Peter, which is that it's the end of the beginning.
Yep, and it's exactly what Larry Summers said. Larry Summers was, he wasn't at the New York Stock Exchange, but we had a breakfast before the opening bell, and he patched in remotely, and that's exactly his words was that it's the end of the beginning, and I think it's very true. This is chapter 1 of Lending Club is over, and now we're entering chapter 2.
Yeah, and I think coming back to the point you make about what will keep them honest, which is competition, I think we do get to be the beginning of the end when there are some anti-competitive things going on, which obviously we've seen in Wall Street for quite a while, and just looking this week from a UK perspective on America, sometimes America seems very similar, sometimes it's very different. And one of the very different things was all this media publicity given to Jamie Dimon, chief executive of JP Morgan, calling Congress and getting this sort of Dodd-Frank bit slipped in there and all this kind of stuff. That's sort of fairly extraordinary. So Wall Street's sort of political power is as strong as it ever was. And one of the reasons that the new fintech players players can do so well is that the old financial services players are charging supernormal rates to people on both sides.
Yeah, and I think that's interesting. I've seen several articles written just in the last 2 days by people saying, what's up with the banks? Why aren't they paying attention? Why aren't they doing something? Why are they just letting Lending Club in here, getting a free lunch kind of thing? And, I think banks still don't know what to do. They have a very profitable business. Their credit card business is extremely profitable. They don't really want to cannibalize that. So a lot of them are sitting on the sidelines. Now, Lending Club's line is that they want the banks to partner with them, and some are already doing that, and maybe they will in the future. It's going to be a while before a Chase or a Citi or a Bank of America is going to partner with Lending Club. They may do it in 5 or 10 years' time, but they don't really know what to do right now. And it's interesting. It's going to be a fascinating thing to watch. And I think it's one of the risks that Lending Club has to really bear is that a big bank with deep pockets, banks are extremely profitable businesses, and big banks with big pockets could come in and really try and take them on head on. And it hasn't happened, and I don't actually see it happening. But if there's a young, forward-thinking CEO comes in and replaces Jamie Dimon one day, and he's been a Lending Club investor for 5 years, then we may see something more interesting. Now, I don't think it's possible to take Lending Club out anymore. I think they're too well established, but you could certainly make their life more difficult.
Yes, it's the old price competition, isn't it? I think I remember hearing a talk by somebody, and I've forgotten whom, and it was a UK one, and they were saying that their borrowers really love them, but they're not necessarily cheaper than the banks. They're just better service, yardy. So
yep.
In those circumstances, if the banks drop their margins, etc. Anyway, that's another one for another day. So very exciting times as we end 2014. And I find what you say, that's very interesting times going forwards. And just one small technical thing there, which we mentioned in passing, which was in the UK, you hear time and time again, and I think it's true, that the government is very pro-fintech and the regulation is fairly light touch and all that kind of stuff. And it's not always the case elsewhere. And in the US, somewhat, crowdfunding isn't really particularly sort of legal at the moment. And then this amazing thing which happened, I think it was, 08 or 09, when Prosper and Lending Club had their quiescent periods, which is that, as you say, the SEC said that everything that went through them, maybe this was an anti-competitive move by the establishment, everything that went through them has to be listed as security or something absolutely bizarre, which is massively burdensome.
It is. It's massively burdensome. That was a moment where the whole industry could have just sort of rolled over and died, because it added a huge burden onto Lending Club and Prosper, for that matter. It made breaking even, getting to a profit, much more challenging. Now they've weathered that, but I think in the UK, the UK P2P lending industry is very, very lucky. The government there is probably the most supportive of any government anywhere in the world, and they've been able to grow up in that industry. You've got the UK government investing in loans on Funding Circle, which has been around now for quite some time, and they've re-upped and done it again. I've talked to people in the US government, and they say, boy, we'd love to do that, but we just can't. There isn't the political will to get in there like that. And I think the US has had to do it despite the fact the government is trying to put up roadblocks. And then when they say they're trying to put up roadblocks, they're trying to protect the investor. And that's their whole reasoning. The final chapters in the regulation of this industry have yet to be written. I think we will see some changes at some point when Lending Club and Prosper and a few others are public and it's a major industry. I think we will see changes that hopefully will be less burdensome on these platforms, because the government is fully aware that these companies are providing a valuable service to the borrowers. They're making borrowing easy. They're stimulating the economy, particularly on the small business side. It's very, very positive. They need to do something to make it easier for these companies. So I think we will see some changes, but the UK is leading the world, and the US are certainly paying close attention to what the UK government's doing.
Yes, I think that's true. Again, I think it comes back to the political powers. So around 2008, 2009, I obviously had a lot of exposure to the UK, and also quite a bit of exposure to Iceland, which went bankrupt. I was doing a gig for Landsbanki at the time, and when they fell over, they hadn't actually paid the last 5 months' invoices, which was unfortunate. So I spent some time sorting that out. But I spent quite a lot of time with the Icelandics. And it's a really interesting point, and I don't think I ever heard this suggestion in the States. So when you had these banking crises, Iceland and America had the opposite approaches. So basically in America, lots of poor people were bankrupted, and in Iceland, the opposite. They bankrupted the banks and left the people untouched. So those are kind of two extremes, and you can put the UK somewhere in the middle. Now, the banks have got quite a lot of political influence in the UK, but nowhere near what they have in the States. It would be inconceivable over here for there to be a chief executive of the banks calling the sort of, the government when they're doing the autumn statement and all that kind of stuff and getting provisions put in. But that's another story. Anyway, I just always find it very interesting that Iceland took the opposite approach, which was to bankrupt the banks, not the people.
Right.
Maybe it's a real democracy. Who knows? Anyway, coming on to the light touch regulation and looking after people, Peter, then maybe you can tell us more about your whole range of activities that you do have, which are very wide. One of which is educating individuals and also companies and working with them consultancy on how all this stuff works. I started my career in the Eurobond market where investors were supposed to look after themselves. And of course, in the UK, it's gone very much towards a nanny state. Nobody's allowed to lose money. Nobody's allowed to take a risk. That's just terrible. But education is a massive part of this.
Yeah, and that's one of the things that really, when I first started in this business, that was the thing that I felt I wanted to do. I wanted to educate and spread the word. I wanted people to know that this is a great investment opportunity. So, I've written now almost 1,000 articles on Lend Academy, and the focus of a lot of those is furthering the knowledge of the investor. That's what I want to be able to do. And so for the premise for Lend Academy is really educate. I'm also co-founder of the Lend It conference, and that's another thing I spend a lot of my time today doing, and it's all about really connecting investors and platforms together. So bringing everybody together. We had our first London conference in November of 2014. We will be back again. It'll be in October of 2015. We will be back in London for the second version, and we've had several conferences here in the US. We had a conference earlier this year in China. We'll be back in Shanghai over the summer in 2015, and it's all about really connecting people who want to deploy money onto these platforms with the platforms and really furthering the industry, bringing everybody together for education and networking in a sort of an intense 2-day format. That's something that I feel very strongly about, and I really enjoy doing. And then the third thing that I do, we have an investment management firm, Lend Academy Investments. And this really began from people asking me to manage their money. They say, look, I love Lending Club, I love Prosper, but I just don't want to do it myself. Can you just do it for me? And so we set up I've got two partners. We set up Lend Academy Investments, and we will deploy money. We have a private fund, and we also have accounts at Prosper and Lending Club where we manage investors' money and help them basically put their money to work on platforms.
Yes, this is interesting. It's totally slipped my mind at the moment, and you will know it, but the name of that closed-end kind of investment trust over here that invests in UK peer-to-peers.
It's P2P GI. It's run by Simon Champ. It's Eaglewood Europe. The ticker symbol, I think, is just P2P. It's traded on the London Stock Exchange.
Do you have plans potentially to do a similar thing over there, which is just basically offer people a sort of a fund, whether it's open-ended or closed-ended? Because from my perspective, in the UK, you can put your money with a Zopa or a rate setter, as you say, and they kind of manage it on a sort of pseudo-savings product. I mean, it's not politically correct, but basically they're very low risk and they'll sort of look after your money for you. If you're talking about the US, as you say, there's a much greater range of borrowers. As I've heard on some of your podcast, it's far more technical over there. You having to get involved with APIs, automated stuff, and faster. And I think if I was going to just personally invest in US assets, I would probably much rather give a real professional with a deep background like yourself, Peter, my money for a modest fee, and you take care of it for me. I'm not just waving the flag for it. I'm an ex-fund manager. As an ex-fund manager, I don't give my money to anybody and pay them fees because I know that very rarely do fund managers add more value than their fees. But in this particular case, in a very technical market like this, assuming the fee was low enough, then I think it makes a lot of sense.
Yeah, and that's our value proposition really to investors. I mean, lendacademy.com really caters to the do-it-yourself investor. We try and educate people on how to do it yourself, but we recognise that probably the vast majority of the population don't want to do it themselves. Look at the popularity of mutual funds, throughout the world, and particularly in the US, where that's the way the vast majority of people invest in the stock market is through a mutual fund. We think the vast majority of investors in this asset class will want to invest in some kind of fund structure. And the people over at Eaglewood Europe think so as well. And you can go and buy shares in their publicly traded entity today. And I think we're looking at all sorts of things at Lend Academy Investments. That is one of the things we're looking at. We certainly want to be able to help as many investors as possible. Obviously, it's not a trivial exercise to create one of these kinds of funds. So, we're looking at it. But right now, today, we're sort of focused on helping out investors, who I would say not necessarily wealthy investors, but people who want to put $25,000 or $50,000 to work and don't want to do it themselves. That's really our focus in the US today.
Yes, well, in terms of this whole thing maturing from its origins that you mentioned, which are less than 10 years ago, and now December 2014, we've got a couple of IPOs, then it really will have matured, I feel, when it just becomes an asset class in its own right, so that, a pension fund will say, oh, we want 70% in equities, we want 15% in bonds, we want 10% in, online lending and borrowing, or whatever you call it, and 3% cash.
Yeah, exactly. We're still, I think, a few years away, maybe hopefully only a couple of years away. I think we're realistically a few years away from that happening, but I am absolutely convinced that's where we're going. We are going to the online lending asset class. It'll be split into sub-asset classes like, real estate, small business, consumer, and people will say, one day they might say, well, I want a 20% allocation to online lending split between those three asset classes. And I am convinced definitely within 10 years and probably sooner than that you're going to go along to your financial advisor and they're going to say you need to put a certain percentage of your portfolio into online lending.
Absolutely, absolutely. Well, in that case, Peter, I wish you very well for the future in terms of all those plans. And I think that, all of your hard work and dedication to the scene over many years when it was unglamorous and people weren't sort of calling you, asking you about IPOs, will really pay off. And you do have the first mover advantage, because it's very difficult for anybody, if not impossible, to suddenly turn up today and be a commentator in the States without that kind of historical perspective.
I always welcome more people entering the space. I think that the space is very big, and I'll continue to work hard. And this is a labour of love. I love what I do, and I plan to do this for the rest of my career. And but I think there's plenty of room for others, and I feel like we are, we're a fairly collegial industry right now. Our competition isn't each other. As Ron Suber from Prosper always likes to point out, our competition isn't even the banks. Our competition is the fact that so many people don't know about this. We need to address the awareness in the general population. Now, the Lending Club IPO helps to some extent, but we need more and more successful IPOs. We need more coverage in the general press, and then we're going to get more awareness, and that will help drive this industry forward.
Great. Well, that's an excellent note to end on. And as I'm staring at a Skype screen here, I'm reminded that Tarvet Henricus was saying that inertia is a huge factor as well, and that even though Skype has been free and been around for at least 10 years plus, its market penetration is still, forgotten the number, but it's stuck in my mind, something like 8% or whatever. So the early adopters get in there fast, but the majority of the market takes time to move. So thank you very much for that, Peter. And I'm glad there's been no gas leaks today.
Yes, me too. Thanks a lot, Mike. I appreciate you having me on.
Okay, cheers.
Bye.
Thanks for listening. If you enjoyed the show, please subscribe on iTunes or your podcast app, or sign up at londonfintechpodcast.com for email alerts of new episodes. Live long and prosper.
We could sit in a bend there all day, watching the firelight dance, watching the firelight dance. We could walk in the mountains before dawn, watching a happy moon ride, watching a happy moon ride. Come away from the city, with the tarmac so dead and the people so sad. Come away from the city, with the faces so grey, with the pain of the everyday. We are wild like the mountains and the trees. Can you see what I mean? Can you see what I mean? We fit in between the earth and the sky. Kiss the city goodbye, wave the city goodbye, wave the city goodbye. city goodbye. Watch the firelight dance with me. 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 Watch the firelight dance.